Are higher rates purely a reflection of optimism in this economy?
Yes, I think the higher rates are really reflecting a higher trend growth first. We were basically growing at 2% real. And with this fiscal stimulus, we're going to increase that by at least 0.5% to 2.5%. So part of it is just that growth is going to pick up near term for the next year or so. And secondly, we are seeing a little bit of a pickup in inflationary expectations. Remember, these fiscal deficits have to be financed. One thing that's happening in the marketplace, which really I think Pimco was ahead of the curve on, was we're going to see a $450 billion increase in Treasury issuance growth this year versus last year. And so the market's simply digesting this new Treasury supply, which has to finance these deficits going forward. And so we have been pretty cautious on rates. But a lot of that backup has occurred. We've seen a 90 basis point or 0.9% backup in 10-year yields from 2 to 2.9 in 5.5 months. So we've seen a big move in the markets.
Right. Now, the 5-year is already at 2.64%. The 10-year reached 2.94 and change. You had a 3% call on the 10-year. Are you sticking with that, given how markets have been repricing?
Well, we had been underweight interest rate risk for a long time, and we're turning more neutral now. We think a lot of this move has occurred. There's no question that the market has to digest this supply, but you're getting to a point where bonds are starting to get exciting. And we haven't been able to say that in about 3 years. But if you look at the way these markets have evolved, if you go back 3-5 years ago, remember, cash was yielding almost zero, bond yields were very low, and the place to be was equities and real estate. Now, with equity valuations having run up significantly, you can now get high-quality bond funds yielding 4 or 5%, and cash is now going to be heading to 2%. Cash and bonds actually look pretty good now relative to equities. So the market for bonds, again, is getting more interesting.